of the financial changes that have happened with the start of this current financial year, there are some families that are finding an extra few dollars that they may well be thinking, what am I going to do with this? Well, obviously, one thought is to pay the extra high electricity and other charges that we'll be all copping because of the carbon tax. But there are some other things we might be able to do with it investment-wise, and it's good to be able to talk to Gavin Martin from Cornerstone Wealth, who's back with us today. Hi, Gavin. Welcome back to 2020.
G'day, Neil. Great to be with you, and happy new financial year.
Yes, thank you. Gavin, when it comes to the changes that have taken place, tax-wise, from the beginning of this financial year, some of us are still getting our head around what's actually happened. We've seen an extra few dollars in our bank accounts, there's an extra few dollars in our pay packets. It can be deceptive because the price of things like electricity are rising too.
Yes, exactly. There's been a few changes. So one is that there's been, all really off the back of the carbon tax and the related changes to tax threshold and then the clean energy advances. So payments that happen before the end of the financial year so that we would be able to afford the higher energy bills, as you just mentioned. But I think it's important to encourage people at this time not to just flitter that money away. I heard reports earlier in the week about the amount of money or a boom in the amount of money going through pokies at this time because of these advances that have come through before the end of June. So just an encouragement to people to think about they are actually getting tax savings this financial year. They've had some payments through the clean energy advances. They might have also had a schools bonus of $410 for a primary school age child and $820 for a secondary age child. So just encouraging people to really think through that they are actually getting a little bit of extra cash. How about use that to either pay down some debt or to put aside for some other major purchases, and not just see that go out into the ether and not really understand where it's been utilised. So
the advice is don't squander the extra few dollars because you can actually do something really useful with it when it comes to investing.
Yeah, certainly, and that could be a range of things. The important thing is to making sure that you just don't squander it, as you say. And I've been talking recently to people about how to budget and how to make sure that they don't just squander money. And the majority of people that I speak to don't actually budget on a day-to-day basis. They don't actually record exactly what they're spending each day or each month. So I encourage them, if they're not going to go down that track, then they really need to set up their accounts so that they ensure that they put some money aside straight away. And you could think about doing that with that money that came through before the end of the financial year, putting that aside to ensure that you either pay down some debt or you put it aside to pay for the higher energy costs later. And structuring accounts is a really important default budgeting mechanism if you don't use the traditional record everything you spend approach.
The way that the tax cuts and those payments are structured too, Gavin, means that the lower income earners are ending up with more money, but they're the ones who are more likely to need it because of the rising prices.
Yeah, exactly. So if we look at the tax savings for this financial year, so someone earning $20,000 will say have a tax saving of $600 for this financial year, the 2012-13 financial year. Someone on $25,000 will save $503. And if you're earning between $30,000 and $65,000, the tax saving is going to be about $300, a bit over $300. If you're on 70, it's about $250, and then once you hit $80,000, the savings are negligible, about $3. So yeah, they are some significant changes. Those people on the lower incomes, because they do need more assistance to pay for the increased energy costs, etc., they're getting a bit more of a saving.
There is an ongoing benefit if it was a lump sum, because when you calculate that, you say over a year it's $500 or $300, but because it's trickling through each week, it's an extra few dollars in the pay packet. Does that make it a little bit more difficult to administer and actually do something special with it?
Yeah, it does. But if you have the function where your employer allows you to direct a small amount each month to a different account or a different location, that's a great way to ensure that you don't just see that money go squandered. You can do things like direct that $600. If you're on a $20,000 income, you'd be fully eligible for the government co-contribution. You could direct that money to your superannuation in after-tax dollars, and that would then, partway get you the government co-contribution. So, you can actually double or effectively boost the amount of tax saving by combining it with some other strategies as well.
Interesting point you've raised there, because not many people, I guess, have that special appointment with the paymaster or with their boss to find out how they could direct a few dollars from their pay packet to a different account or to different things, extra superannuation, those sorts of things. Is that worthwhile? I mean, you might not go to a financial advisor as such, but just go and talk to the paymaster and find out what sort of flexibility there is to actually help you keep on top of your finances.
Yes, definitely. You can do it in an after-tax means, so you can say, you employer, take some tax out of this money and then direct this over into another account. Or alternatively, and this is probably one of the major ways in which we can save some tax, is you direct some of your money from your income before your employer pays tax to your super fund, and you can then save a significant amount of tax. And whilst that strategy has been pulled back a little bit with the new thresholds for this financial year, it still is one of the major ways in which financial advisors recommend in saving some additional tax.
And not every employer actually has that provision, do they, to do that sort of salary sacrifice or paying things with pre-tax dollars. Not everyone has the benefit, but if you do have the benefit, you shouldn't let it go by.
Yeah, exactly. And most employers, I haven't really come across any employers that won't allow it these days. Sometimes they don't necessarily understand, or the person administering doesn't really understand the benefits of it or the limits that you're that you need to stay within. But if you're able to tell your payroll person exactly what you want to do, generally they will help facilitate it, because there are significant benefits for people that do it.
If you're going to structure your finances in such a way that you do move some dollars to a separate account, what sort of titles on those accounts do you think? I mean, we're talking about saving these dollars and not necessarily investing them, but a separate account for money put aside for a rainy day or educational expenses. What sort of things do you suggest that you might be able to save some of these tax savings and extra money in our pay packet? What should we put that money towards?
Yeah, really, really good point, Neil, because depends on what our situation is. If we've got consumer debt, we should put it directly against consumer debt, so credit cards, car loans, store cards, personal loans. Put it straight against those loans and get those paid down as soon as you possibly can. If you haven't got any consumer debt, then the best thing is to develop an emergency fund of, say, 3 to 6 months living expenses. If you've got that emergency fund in place, then it's really about saving for major purchases. So that might be to purchase a new car, or a deposit for a home, or a trip, a holiday, or starting a business. If you've got all those in place, then you can really start to think about paying down the mortgage, focusing on getting the mortgage paid down further, and then it's really about investing and how can you best invest the surplus funds after that stage. So it depends on where on that spectrum you are as to what you would do with the surplus funds.
And of course, getting some personal advice from a financial advisor if you are concerned about your own personal circumstances too. Gavin Martin is from Cornerstone Wealth, and the advice today: pay down that debt, set up some money into an emergency fund, and then think about saving for those big ticket items you might be saving for. Gavin, it's always a pleasure. Thanks for being with us today on 2020.
Thanks again, Neil. Great to be with you.